here where I will be doing tutorial set on financial accounting, basically introduction to what accounting for your second semester, right? And so this is Dasibre. Usually I'm called Obed in Dasibre, but you can call me Dasibre. So guys, I'm going to do an online tutorial session for your exams. And in this video, I'm going to walk you guys through 4 most important areas in your syllabus. So out of the 6 topics that will be coming in your exams, I'm going to walk you guys through 4 of them, and then we will dive them into details so that I will show you how to solve questions, tackle questions in these areas so that it will help you in your final exams, help you to ace those exams with less stress. So basically, I'm going to focus more on these areas, and that areas are: 1, we are going to discuss about the partnership accounts. So partnership accounts will be the first topic that we are going to discuss. Partnership accounts. Partnership accounts. From partnership accounts, we move on to departmental accounts. Departmental accounts and manufacturing accounts. Yeah, I'll do these two topics together because they are related, and it will help you to solve a full question on manufacturing accounts. But departmental accounts will not come in your exams, but then you need some knowledge in departmental accounts to help you solve question on manufacturing accounts. So I'll be doing a separate video on departmental accounts and then manufacturing accounts, right? So once we are done with these two, we will also move on to the error correction. Error correction. Error correction. And then the suspense accounts. Then finally, we will end by looking at the financial statements analysis and ratios. Okay, so guys, these are the 4 areas that we are going to discuss from now to the end of the tutorial session that I'll be doing to help you with your exams, right? So basically today I'm going to start or begin with the partnership accounts. In these partnership accounts, we are going to focus on the final accounts of partnership, right? Yeah. So as you can see, partnership is a business where 2 or more people come together, pool resources together to start a business. And this business that they are starting, they aim to make some kind of profit in the end of the business, right? So that is basically what a partnership account is. So straight away, let's move on to the final accounts of the partnership firm. Right. Yeah. So in a partnership, final account of a partnership business, one of the components of the final account of partnership is the income statement, what we call the trading profit and loss account, then the profit and loss operation account. Then we also have capital accounts and current accounts. The last one is the statement of financial position, or the balance sheets we already know, right? So these are the 4 final accounts of a partnership, right? Yeah. So we are going to start the discussion by looking at the income statement. So guys, in your exams, there are 2 things that you need to be looking out for when you have a question on partnership accounts. So these 4 components are basically what you are going to prepare for you to earn the full mark for every partnership account question. So these 4 components will be required that you prepare them in accordance to the question. So now the income statement, some issues with regards to the income statement is that it's either or not you'll be required to prepare a full income statement by yourself. And this has to do with the information provided by the question. Some question will require that you prepare the income statement yourself or not, right? So since we already know how to prepare an income statement, we will assume that they have prepared a final account for us and they have given us the reported net profits or loss as a result of preparing the income statement, right? Now, if they have given us the reported profit for the income statement, then what are some of the things that we need to do with this reported profit? Basically, you see, partnership account is not like that of a soup proprietor. So this profit will have to be shared among the partners in the business. So that's to also give us what we call the appropriation accounts, or what we call profit and loss appropriation accounts. So basically the reported profits or the adjusted profit or the income statement profit that you determine in the income statement will be shared among the partnership, the partners in the business. Now, one thing that you need to also know is that this income statement profit that they have given to you, you are not just going straight away to share it among the partners in the business. No. You need to consider certain things, because as the income statement was being prepared or was prepared, they prepared the income statement maybe last year or something. They did not record certain items in the income statement. So those items will be provided to you in the question, and you as the students or the accountants, you have to do some adjustments on them so that you adjust the reported profit in an account called statement of adjusted net profit for the year ended. Do you get it? So you need to adjust the net profit that they are giving to you in the question. You have to adjust for them. So in case they don't ask you to prepare, or maybe in case they don't give you a full information about the items that you need to use to prepare the income statement yourself, you be provided with certain items that were not included in the financial the income statement. Do you get it? They will provide you with certain items that they did not record as when they were preparing the income statement. So those items, you need to adjust them on the reported profit that they gave to you in the question. Do you get it? So that will give rise to an account called adjusted net profit for the end of the year. So to adjust that net profit, you open this account called the statement of adjusted net profit for the year. Then you adjust the net profit. So first, you bring forward the reported profit that they give it to you in the question. You record it, then you write the figure over there. Then you now add all items. Those omission reduce what? Net profits. Net profits. You add all items. Those omission reduce your net profits. Example is goods withdraw omitted. You get it? So all items that will reduce what? The net profits will be what? Added to what? The reported profits. Now, why are we adding what? Goods withdraw omitted. Okay, so this is the reason behind the reason why we are adding what? Goods withdraw omitted. Now, goods taken for personal use will reduce the profit of the firm as a business, because the cost of the goods have not been taken from the books already was recorded. So as an example, let's say we the business, we bought what? We bought what? 10 what? Pence. 10 pence at 10 pence at 1 GH each. And then so in all, we are going to record 10 cedi as cost of cost of goods sold. Cost of what? Cost of what? Cost as cost price. You get it? As cost price. Now, after recording this, we also sold, maybe we sold all the pence. You get it? So sold what? The 10 pence. We added some profit margin to the cost price. So the cost price is 1 cedi. So now if you are going to sell the 10 pence, we are going to sell the 10 pence at, let's say, 1 cedi 50 pesos, right? Each. So you are going to make and record sales as, and record 15 cedis as sales, as selling price, right? As selling price. Now profit will be what? Now profit will be 5 cedis. Profit will be what? 5 cedis. That is the 15 cedis minus what? The 10 cedis. So profit will give us what? Profit will give us 15 cedis. Profit will give us 5 cedis. You get it? Now, let's assume we withdraw or we took what? Withdraw 2 pence for personal use without recording or accounting for these 2 pence that we have taken out of the pence that out of the already 10 pence that we have in our business. So we didn't account for it. We didn't record it. Now our selling price will be what? Our selling price is going to be what? Because we have taken what? 2 pence. Now we don't have 10 pence anymore. We have what? 8 pence. So now our selling price will be what? Our sales will be what? Our sales will now be what? Our sales is going to be what? 1 cedi 50 pesos times the remaining pence now will be what? 8 pence, which is going to give us a sales of what? So 1 cedi times 8 will give us 12 cedis. Do you get it? So we are going to earn 12 cedis as sales. Now if we find profit now, profit will be what? Profit is going to give us 12 cedis minus the 10 cedis, which is going to be 2 cedis. So our profit will now be what? 2 cedi. So you see, the goods that we withdraw and we didn't record is now giving us what? 12 cedis as sales. So when you subtract these 12 cedis from the 10 cedi cost price, you are going to end up getting 2 cedi profit. You see that the profit has what? Reduced to 2 cedi. Initially, when we sold them, we had a profit, we had a sales of what? 15 cedis. But now that's what? We took 2 pence without accounting for and without taking the price from the already recorded cost of the 10 pence. Do you get it? So that means that whenever you withdraw money, you withdraw cash or goods from your stores, you need to account for it so that it will not affect your profits. So that is why we are going to add profit. We are going to add goods withdrawals omitted to the adjusted to the net profit of the firm. Now after adding all items, those omission reduce net profit. You will now less all items, those omission will also increase the net profit. So basically, example will be item that will increase what profit is what when we don't account for them. So if we have item that will increase profit when we don't account for them, is what? Example is what? Liabilities and general expenses. So liabilities and general expenses are things that we have to make payments. We owe to what? Third parties. You get it? So when we don't record these things, we don't account for these things, they likely going to increase our profit. So the implication is that to solve this problem, we need to what? Less them so that we will get the desired profit that we need to what? Ascertain. Do you get it? So all item omission will increase profit will be what? Subtracted, or we say less them. You less them from the what? The reported profit. Then after we less them, the net amount now will give us what you call the adjusted net profit. This net profit adjusted is what you are going to what? Carry or transfer to what? The next account, which is the what? Profit and loss appropriation accounts, so that we will share among the what? The partners in the what? In the business, right? So partners profit will be shared among them in an account called profit and loss appropriation accounts. This profit and loss appropriation account is similar, is an additional section toward the income statement that is used to share the profit of the firm to the partners involved in that business. Please, are you here? All right, sure. So basically, this is how you go about adjusting the net profits of the business. So now let's move toward the profit and loss appropriation accounts, and then you look at how to deal with that one too, right? Yeah. So as you can see on the screen, this is the interface of the profit and loss appropriation accounts. Right, the table. Now you see the interface of the profit and loss appropriation accounts for the year ended. This profit and loss appropriation accounts is just like the nominal accounts we did last semester when we are looking at the various sorts accounts that businesses would open. So basically, these accounts, the double entry is that we credit all incomes or gains to the profit and loss appropriation accounts, and all expenses and losses are also debited. Do you get it? All expenses or loss will be debited to these appropriation accounts, and all incomes or gains to the firm, to the business, to the entity will be what? Credited. So anything that will increase the net profit will be credited, and anything that will also decrease the net profit will be debited, right? So it uses the principal underlying nominal accounts to do the recording. So this is the basic, accounting treatment for recording in the profit and loss appropriation account. Do you get it? So, like I said, this is an additional section added to the normal trading and loss account. So it is this account that you are going to use to share the profit among the partners involved in the business. So first, we will bring forward the adjusted net profits. You get it? You will bring forward the net profit adjusted here by crediting it towards the appropriation account. Right. Then if there is any interest on drawings you also consider it by crediting it. There now, why is the reason? So what's the reason why we are crediting what interest on drawings? Okay, so the reason why we are crediting interest on drawings toward the appropriation accounts is that it's an income to the firm, to a business. So normally in a partnership agreement, indeed, there's um there's there's an agreement that governs the partnership firm called the partnership deed. So any amount, because the initial contribution that will be made by the partners involved, there is a saying that they don't want the partners to be withdrawing their initial contribution anyhow. So there is a restriction to them, so that when they are withdrawing the amount, they will have to pay some penalties. You have to pay some penalties to the business. If not, every partner will like to withdraw money from their initial contribution. So these penalties is assigned to any drawings that any partner would like to undertake, so that to prevent them from not overdrawing their initial contribution. So this interest that they are going to pay on the amount that they are going to withdraw will be an income toward the business itself, and a loss or a penalty or a charge toward the partner who is doing the drawings. So that is why interest on drawings is credited towards the appropriation account. Right. That's why is credited to the appropriation account. Now, the next thing is to also consider if there is share of loss, if any. So share of loss, if any. So if there is a share, maybe after doing all the balancing, and you say that the share of loss, the encounter loss, the share of loss will be recorded at the credit side of the appropriation accounts, because it is a loss to the business. And if there is a net loss from the income statement, it will be recorded at the debit side. To be recorded as the debit side, because it will be seen as a loss towards the it will be seen as loss to the business, right? And we also have interest on capital being debited to the appropriation accounts. Interest on capital being debited towards the appropriation accounts. All right. So interest on capital is debited toward the appropriation accounts. So interest on capital and interest on current accounts decrease the appropriation accounts as an expense toward the business. So interest on capital and interest on current accounts is is an expense for the business, because the capitals and the current accounts of the partners, they also earned some interest. So the partners, their capital account earns some interest, and that interest on the account will be seen as an expense to the business, because the business will have to pay them these interest to the partners. So that's why they are saying that it is an what? It's an expense. It is seen as a loss toward the business. So you see, great. Interest on capital. So partners earn interest on their capital accounts. That is what it means. And their current accounts too, they also earned interest on their current accounts. If and only if their current account has a normal credit source balance. Otherwise, if the current account of the partners is having a debit balance in the question, so you have to take note of the balances of the capital accounts and the current accounts in the question. So you have to check from the trial balance if the current accounts or the capital account is having a debit balance or credit balance. If they both have debit balances, then that means that they have overdrawn the accounts. And the implication of them overdrawing the account, the interest on it will be an income to the firm instead. So if the current and capital accounts have debit balance, then interest on them will be an income to the business. Do you get this? So if the current account and the capital account, they both have debit balance, said that means that the partners have overdrawn the account. So they are owing the business. And since they are owing the business, the interest that they are going to pay on it will be seen as a loss to the partners. So it will serve as an income toward the business. So that for that instance, the interest on it will be credited toward the appropriation accounts. But if, however, they both at the two accounts have credit balance, then the interest on it will be credited, as you can see, will be debited. So if the interest on capital accounts and interest on current accounts will be debited only if and only if the the balances of the two accounts, the capital accounts and current accounts, has a credit balance. So if they have credit balance, then interest on them will be an expense to the business. So in that case, it is going to be debited to the appropriation account. And salary too is seen as well as an expense, a loss. So in that case, the salary will be paid toward the active words. So salaries are paid to only active words partners that are doing most of the work. They do everything in the business. Those partners will be paid what additional what salary, additional amounts for their services that they are providing. So that partner will debit the salary that you are paying him or her to the appropriation account. Then finally, you balance off the accounts. Balance of the accounts, then you check which side is what bigger and which side is what smaller. Then the bigger side will be seen as the total for the two sides, the credit and the debit sides. Then you subtract the lower side from the bigger side or the totals. Then the net amount, the lower what figure will be what we call as the share of profit. So that will be the profit that you are going to use to share the profit among the partners. Now, how do we share the profit among? The profit is going to be share among the partners using the profit and loss sharing ratio of the partners involved. We get this. We're going to use the profit and loss sharing ratio So we are going to use the profit and loss sharing ratio of the partners to share the profit among the So this is how we are going to work. Basically, that is how. So if partner A ratio is worth 2/3, and so the profits, this is how we are going to share. So 2/3 times the profit to be shared times profit to be shared. And if partner B to us, if partner B profit is also 1/3. They get it. Now we are going to share the profit for partner B will be what? 1/3. 1/3 times the total profit. Right. Yeah. Or profit to be shared. So this is how we distribute the profits of the to the partners in the firm. All right. So after we are done, you see that the debit side and the credit side will be equal. They have to vehicle. So this is how we prepare the appropriation account. So now we are done with the appropriation accounts. We are moving on toward the sometimes too there will be a commission remuneration for active partners. Those ones will be debited to the appropriation account. So anything that is seen as a loss or an expense, say that you debit toward the appropriation account. So right. So let's take note of that. It's very necessary. All right. So now we are moving toward the capital account of partners. So with the partners capital accounts, basically we have two types of partners capital accounts. We have two categories. We have what we call the fixed capital accounts and what we also call the floating capital account or the fluctuating capital accounts. So basically, when it gets to these points, students are usually confused. They don't know what to do and what not to do. So I would like to simplify this session very well for your consumption. So this capital account of the partners, in the question they will tell you whether the partners capital account is a fixed one or what is a floating one. So when they say it is a fixed capital account, the partners capital account is a fixed capital account, then that means what it means that the accounts should be the same. The balance of the capital account must be the same. You should not change the balance. You are going to record the exact figure that they will give to you in the question under the finance by. When you are preparing the balance sheet, you are going to record the same balance given to you in the question under the finance by, because we say that it is fixed. Fixed means that it's constant, it's the same from one year to the other. Last year balance will be the same as this year balance when you are preparing the final accounts of the partner. Do you get it? Great. So you debit, you maintain that you maintain the same the same balance given to you as the question. And now there is some issues around the capital accounts, and this is where the problem comes. So please let's listen well, and so that we will get the concept for the capital accounts or the partners. Now, if the question says that the capital accounts or the partners is a fixed capital, then what it literally means is that you would need to create a current account and record all other items that affect the capital's the partners account. Because this capital, we are not going to touch it. You're not going to touch it. You're not going to touch it. We are not going to open any account to record anything over there. You're going to take the same, the same words. We only add additional capital introduced to it when we are preparing, when we are taking it or we are transferring it to the finance bank. So if there is any additional profit, then that additional cash or goods that you are adding to our capital, you add it or you subtract it if there is any drawings from the capital drawings. Then that's the only thing that you are going to do. So any other item that will affect the partner's account, you open a new account called the current account. Do you get? You open a new account called the current account. That current account is what you are going to use to adjust the changes in the capital accounts. So it records items that are of recurring nature, which affect partners' balance. Because you want to maintain the capital account of the business first. You don't want to touch it. So if you don't want to touch it, then we will have to open an account that can help us do any adjustment to the partner's capital accounts. And that account is what we call the current accounts. The current account is there to do any adjustments or changes on the capital account. If it is only fixed capital accounts, then we need to open an account called current accounts and do all the adjustments over there, all the adjustments in that account. So on your left side, we have some information over there. Yeah. So see, I can have highlighted something. The current accounts records items like interest on capital, drawings, salaries, share of profit and loss, and interest on loan. Together. So all these items will be computed or be transferred. And usually the appropriation accounts transfer the corresponding account that's the appropriation account will be transferred to the current account. So all the items that we have, we recorded in the appropriation account here in this accounts, the appropriation account, you are going to transfer them to the current account. So interest on capital is at the debit side of the appropriation accounts. In the current account, it will go toward it will go toward the credit side. Interest on capital account is at the debit side of the appropriation accounts. At the current account, it will go toward the it will go to the credit side as an income toward the partners. The same way salary will go toward the credit side of the current account. And share of profit too will go toward the credit side of the current accounts. And the share of loss will also go towards the debit side of the current accounts, as well as the interest on drawings will also go toward the debit side of the current accounts. And if there is any drawings, it will also be recorded at the debit side of the current accounts. And one thing that you also record in the current account is interest on loans. Interest on loans too will be recorded at the credit side of the current accounts, the credit side. Right. So, guys, this is what you need to know. So, if the question says the capital account of the partners is fixed, then literally you are going to create a current account and do this adjustment, transfer all the items in the appropriation accounts to the to the current accounts. So the items in the current account, it is only interest on loans, interest on loans and drawings, interest on loans, interest on loans and drawings. These are the two items which do not go towards the appropriation accounts. Drawings and interest on drawings, they do not go towards the appropriation accounts. Do you get it? They don't go toward the appropriation accounts. Interest on drawings is coming from the income statement under what? Operating expenses. And these drawings will be given to you under the footnotes. So you have to pick it from the footnote and bring it here. So after recording all the items in the current account, you need to balance it nicely and take the balance. Now the balance on the current account will be transferred to the finance by. When you are preparing the balance sheet, then you take that balance over there together with what? Together with the capital accounts. So if the question say the capital account is what? It's a phase one. That means that after the finance by, we are going to record two things. We are going to record two things. And the things that we are going to record is that if the question say that the what? If the question gives you face capital account under finance by under finance by, you record these things. You record for the face capital account, you record capital account balance. That is what is the face. That's the face account, the face account itself, plus the current accounts that you calculate, the current account that you open. The balance on that current account will also be transferred under the finance by. Under the finance by. You get it? So we are going to record these two items under what? The finance by. So then you also record current accounts. The balance on that account will also be what? Recorded for the two what? The partners involved. So we record these items. This is how we are going to what? Record the finance by aspect of the what? The balance sheet. That is when the question sees that, or the question gives you a face capital account. You get this? The one that you will not touch, that is the face account, to go to a physical capital account. And the current account that we calculated and we adjusted for any additional and any income and all expenses in the current account, the balance on it will be at the current account. So basically, this is how we will also tackle the capital accounts. Now, the second category of the capital account is the floating or the fluctuating or capital. Now, this floating or fluctuating accounts, capital accounts, here, this one, it is not fixed. Last year balance. So the fluctuating capital, fluctuating or the floating is not fixed. It varies. It varies from what? Year to year. Yearly, every year there will be different capital balance for the partners. So if last year balance is 2,000, then this year balance, then this year balance will be different. It will not be the same as 2,000. It will be either less or more. Okay, that's what the fluctuating accounts, capital account also means. So basically, if the question says that the capital account is a fluctuating one, then literally we are not going to open any current accounts, because this fluctuating accounts, it combines the fixed accounts and the current accounts in one account. So if you open the fluctuating account, inside the fluctuating account, we have the fixed accounts being recorded in there. We also have any items that we record in the current accounts also in there. So the floating accounts, as you can see on the slides in the Excel, the table over there is the interface of the fluctuating accounts. Within the fluctuating capital accounts, we have the capital accounts figure being recorded. That is the net profit brought forward, the normal capital account that will be given to you. You are going to record it over here. Then if there is any additional income or additional capital that one of the capital or the partners will introduce, you also record it. Then any other items of interest or will change the balance or affect the balance of the partners, you also record it. So all the items that you wanted, like that will affect the current account, will also be recorded in the fluctuating accounts. So we are not going to open any current account. So if the question says the capital account is a fluctuating account, that means you, the students writing the exams, you don't have to open any current accounts. All that you do is that you open the floating accounts, then you record all the items in the floating accounts. We record both the capital account balance. That is the face balance over there. Then we record you transfer all the items in the appropriation accounts to the floating account together with the drawings and the interest on loans, which will not be recorded in the appropriation accounts, also in these accounts. So basically, there is a difference between the fixed accounts and also the floating accounts, and how to go about it. So if the account is a floating account, now what's actual balance are you going to take to the finance bar? Now, if the capital account is a floating account. Here, we are not going to record any current accounts. Do you get it? So under finance by, under finance by, under what? Under finance by, we say that we will record only what? Capital accounts. And this capital account that you are going to record will stand there or will represent the floating account, because we say that the floating account, the floating physical, the floating capital account varies, changes, right? And for that matter, in the first place, we didn't even, open current accounts. So under the finance by, what you are going to record will be the capital account. We record the capital account, and this capital account that you are going to write represent the floating account. Represent the floating account. You only record your capital account, the balances for the partners involved. If there are two, we record them. So partner A, partner B, maybe partner C. You record all of them, their balances. You record all of them, their balance, the balance that you get. You record it right here. DC, you record that in the under the finance by. You record it under the finance by. So guys, this is the two difference between the capital accounts of the partners and how you also go about recording the under the finance by. So we see, if the question is gives you a fixed capital account, you will record both capital account and current account. But if the question gives you what? Floating capital accounts, you only record only the capital account, and that capital account that you write represent the floating accounts, because say that floating account, it will change. The balance of the capital accounts will change. Last year's own will be different from this year's own. So guys, this the difference between the two capital accounts. Now we are done with the capital accounts and also the current accounts. They get it. So we are dealt with them, simultaneously. Now if you are done, you balance off the accounts, right? You check the credit and the debit side. If the debit side is the largest amount, you take the debit side as the totals for the accounts, so that you balance it as you already know, right? Then after you are done, maybe this is the balance CD can come here. Balance CD can either come on the debit side. That's when the credit side is larger or is greater than the debit side. So if the credit side is greater than the debit side, the balance CD will come toward the debit side, because the credit side is greater than the debit side. So the short figure amount will be on the debit side. Then at the end of the day, you carry this here, this figure to this side. Then you record it nicely here. Then you record it right here. Then you record it. Right. If maybe the debit side is also greater now than the credit side, then the totals will be at the debit side. then the balance CD will now come to what? The credit what? Side. Then you call that also here. We call that also here. Then at the end of the month or at the end of the year, we will transfer them to this side. Right. Transfer them to this side. Right. So you have to do the total for A separately. You have to do total for A separately, comparing the debit and the credits. Maybe partner A debit side will be what? Greater than partner A credit side. And that means that if that's the case, partner A debit side is greater than the partner A credit side, then the balance CD will come toward the credit side for partner B. And also if partner B, the credit and the debits, you find out that the partner B total for the credit is greater than the debit side, then that means that the balance CD for partner B will be what? At the what? The credit side. So like this. All right. All right. So this is how sometimes it will be, right? So this basically means that for partner B, for partner A, so that the balance CD is at the, for partner A, the balance CD is at the what? The for partner B, for partner A, the balance CD is at the what? The credit side. That means that the total for partner A debits was greater than the credit side. So that's why the balance came on the credit side. And for partner B, right? And for partner B, the totals for the credits was also what's greater than the debit. So that's how the partner B closing amounts or closing what figure came toward the debit side. So at the end of the day, you are going to pick this, the one I'm highlighting red. You are going to pick this, and you are also going to pick that towards the finance bar. To this, the ones I have highlighted red will be the one that you are going to transfer to the finance by portion of the balance sheets. Okay, so that's all. Now you are going to what? The last aspect of the the capital accounts, and that is the statements of financial position for the year ended. So basically, this is the same as what we already knew from last semester when we were doing the supervisor kind of thing, right? So it is the same thing. It is the same thing, right? It is not that different from what you already know, right? The same thing. Now, so this is how you are going to prepare the balance sheets or financial position of the partner. You start with your non-current assets, the cost, accumulated depreciation, then net book value, right? You record the cost, you apply the accumulated depreciation, whether it is using straight line or some of year digits or whatever. you account for it, you subtract it from the cost, you find the net book value for all of them, then you sum up their totals, then you underline it as I have done it on the Excel. The yellow balance is the total for all the net book value of the assets, the fixed assets. Then the next one is to record your current assets, your cash and bank debtors. Debtors, you see, you need to subtract your provision for that for debt from the debtors amount. Then you carry the net amount to add it to the cash and bank. Then inventory, add it, get a total for current assets. You also come to what current liability. Usually you'll be given one current liability, which is creditors or payables. You also subtract it from the current assets. You get the balance in the red. That balance in the red is what we term as the working capital. So this one is what we call as the working capital. Working capital. You add the working capital towards the fixed assets or the non-current assets, then you get this. This figure is what we call the total assets. The total assets must be equal towards the capital employed. And right, the total assets must be equal to the capital employed so that it will balance the equation. That is what we learned under the accounting equation. Accounting equation says that assets of the business must be equal to the liability and the equity of the firm. So under the finance by, these are the things that you are going to usually record: capital accounts, partner A, B, current accounts, partner A and B, long-term liability, the loan. So the loan, the interest on loan, the loan amount that will be provided to you in the trial balance, you take it here. That's a long-term liability. Usually the loan, it is only one, partner, maybe you will take a loan, then you record that amount over here. So if it's partner A, you record the loan for partner A over here. If it is also partner B, you record the partner B also, partner loan over here. Then you sum all of them up. So when you sum, the total amount must be equal to what? The total for the assets. If you find out and then it is the same, then that means that your account is balanced. Then you are good to go. But if you find out and then it doesn't balance, that means there is some checks need to do. Maybe you have done some mistakes, need to do the checks and get it right. So basically, this is how you have to go through to solve a partnership question. So basically, this is what you need to know about partnership. Right. So guys, if there is no anything more to discuss, you end here, and we will look forward to another upload of our next episode on manufacturing accounts and the subsequent topics that I said I'll be doing videos on them, tutorials, videos on them. Once I'm done, I'll also do a recording on all the four areas, solve a question on them, so that you also appreciate the concept very well. Right. So until then, we'll meet another time in my next upload or session of the next topic, which is manufacturing accounts and departmental accounts. So guys, I will say bye-bye to you all. And most importantly, if you are new here to my video, please subscribe, like, share, comments, And if you have any question, you can also hit me on the chat box, ask your questions for any other clarification or any further explanation. Right. So guys, have a nice day. Enjoy the rest of your day. Bye.